Thank you for joining us for this quick chat. My name is Lucas LaChance and I'm a partner at Lane Gorman Trubit. Today we'll be talking about the new leasing standard and its effect on financial statements. To take us through that chat, I'll be joined by three of my favorite people, Ben Parkey with Texas Security Bank, Christine Allen with Hillcrest Bank, and Amanda Kuhn with Dominion Bank. The new leasing standard will have a pretty significant effect on financial statements. While the income statement will remain pretty much unchanged, along with the statement of cash flows, there'll be a dramatic impact to the balance sheet. And with it, the ratios that most bankers look at when they're looking at your creditworthiness for lending relationships. That's why I'm joined by our three experts today, and I turn it over to Christine to tell us a little about yourself.
Great. Thank you so much, Lucas. I appreciate it. My name is Christine Allen. I am a relationship manager with Hillcrest Bank here in Dallas. I've been in the banking industry for a little over 20 years. I spent 5 years in credit and risk. And before that, I actually have a background in the medical industry. I was a nurse's aide for about 10 years. So when I approach my clients, I really try to approach them from kind of a triage perspective of finding what challenges they have and the things that are giving them the most angst, and seeing if we can put together financial solutions that'll help them either grow their business, take it to the next level, buy out an owner, whatever that happens to be.
Great. Thanks for joining us.
Thank you.
And Amanda?
Thank you for having me. My name is Amanda Kuhn. I'm with Dominion Bank. We actually started this bank a couple of years ago. I've been in commercial banking for 20 plus years for my whole career, all in Dallas. But we raised capital and started a bank in 2019. So it's been pretty interesting going through a pandemic right after starting a new bank. But we've been very fortunate. We did a lot of PPP loans, and the bank has continued to grow. We're about $400 million in assets now. My focus is on operating businesses in Texas. And much like Christine, we take a more, instead of a cookie cutter approach, we try and tailor all of our financial solutions to the client's needs. And because we're small and nimble, we can be a lot more helpful, I feel like, than most of the big banks, because we aren't limited and we can be a little more thoughtful on how we put together financing.
Perfect. Great. And Ben?
Good morning, Lucas.
Morning.
My name is Ben Parkey. I'm the Dallas Market President for Texas Security Bank. We're about $1 billion bank. We were formed in 2008, which was also a wonderful time to start a bank, a bit of turmoil there. And really, we created the bank to elevate the champions of free enterprise. We're big believers in enterprise, and we want to provide, obviously, capital, but also education and support in any way we can. And the best way I'd sum up our bank is, we're a bank built by entrepreneurs for entrepreneurs, and we're excellent business people that just happen to be bankers. So that gives us some perspective and relatability with those business owners out there.
Wonderful. Well, again, thank you all for joining us this morning. One of the things that comes out of this new leasing standard is its effect on the balance sheet, which is where many of the key metrics are derived. And where this most frequently shows up really is in the covenants. So let's talk a little bit about some of the covenants and how they affect the lending agreements. Ben, give us an example, if you would, please, of the impact on how this could affect your business.
Sure. I think a good place to start is kind of getting an overall picture of what the impact of this new lease standard is on predominantly the balance sheet. And then we'll dive into the covenants here in a minute. So let's just use a simple example. So let's pretend we've got service company A and service company B. They're fundamentally the same. They do the same things. Just imagine being very similar companies, and they're occupied in two adjacent buildings. Service company A owns their building. Okay. Service company B does not. So the building owned by service company A, let's assume for this model that it's in the operating entity, so it's on their balance sheet. Service company B again leases the building. Same building, same size, comparable. Lease payments are pretty similar to the mortgage payment. So what do those balance sheets look like? So I'm going to use really simple numbers that doesn't really matter the amount, but let's assume that service company A has $5 million in assets. The largest asset that they have would be the building predominantly. So let's just assume that's $3 million. They're also on the liability side, they're going to have, let's assume $3 million of debt. $2 million of that is their mortgage. Another $1 million is accounts payable, normal liabilities. So their net worth is $2 million. Now, if you imagine and visualize service company B, again, very similar company, they may have $3 million of assets. They may have more cash than service company A because they didn't use that cash for down payment on the building, for equity in the building. So they're going to have $3 million in assets and $1 million in liabilities. accounts payable, normal accruals, things like that. The common denominator between those two, although the balance sheets look very different, one's smaller, service company B compared to A, is that their net worth is the same. It's $2 million, right? So now let's roll out the lease standards on this. And what does that look like? Service company A is not really going to change in this example. Service company B is. So the first thing will happen is there will be a new liability on their balance sheet. And that liability will be the lease. And that's going to be based upon the discounted lease terms of the lease. Has to do with the maturity and the timing of the lease, things like that. And you can talk to our friends at Lane Gorman Trubit for the details on that. Certainly not me, a banker. And then there's also going to be a corresponding asset that's going to be generally based upon that liability. They're going to be very comparable. For this example, we'll say they're even, but it'll be a right to use asset. So let's assume those are both $2 million. So at the end of this example, you look at service company A and service company B's new balance sheet, they're going to look very similar. They're both going to have $5 million in assets, $3 million of debt, and their net worth is still $2 million. But the balance sheet for B before and after looks a lot different. It's inflated. It's bigger. So what does that mean? Well, from my perspective as a banker, I really look at this as more of a reclassification of known obligations. We knew they had a lease. We would underwrite to that. We're aware of that. We understand the impact of cash flow to that. So fundamentally, nothing's really changed in terms of a client's ability to repay debt, their credit worthiness, their debt capacity. None of that's really changed. There's not an impact to the income statement. There's not really an impact to the statement of cash flows. It's really just the optics on your balance sheet. So all that to say, it's not a big deal if you've got a good banker and a good relationship with your bank that really understands your company, because you haven't changed. Your operations are the same. Everything's the same. We're just reclassifying things. But the caveat to that, which Christine and Amanda will get into, it can have an impact on some of your financial covenants. But as I'm sure you'll hear, and we'll talk about this later, that can be remedied with timely and clear communication and a good relationship. Things can be done and worked out regarding this.
Perfect. Great. Thank you. So it sounds like one of the fundamental issues then with this new leasing standard is how it's going to impact the balance sheet and particularly leverage in particular. So Christine, could you tell us a little bit about some of that?
Yes. So there are two different leverage metrics that we tend to use when we're looking at financial statements. One is a balance sheet leverage and one is a cash flow leverage. I'm going to address the balance sheet leverage, and then Amanda will give us some more detail on cash flow leverage. Sure. So balance sheet leverage test is generally a ratio between a company's total liabilities and their net worth or their stockholders' equity. So it's just A divided by B. And there's some adjustments potentially in there, but that's the general concept of that test. So using an example, kind of like what Ben just did, if you have a company that has $20 million of total liabilities, that is the total liabilities section of their balance sheet, and they have $10 million of stockholders' equity, the ratio between those two is 2 to 1. 2 to 1 would generally be perceived as a comfortable balance sheet leverage for many companies. And that's industry specific, and it depends on certain different things. But that's generally not a number that we're going to stress ourselves about, right? And maybe the financial covenant has a maximum of 2.5 times. So each quarter or each month, that company is reporting that ratio to the bank, and it needs to stay under 2.5 times. Well, right now at 20 and 10, those numbers work just fine. If you have a big facility that has a long-term lease, you could suddenly take on a lease liability of $10 or $15 million that suddenly appears because of these accounting changes in the liability section of the balance sheet. As a result, if you take $10 or $15 million onto our 20, well, now that total liabilities is 30 to 35. You still have 10 million of equity, so the ratio is now 3 to 3.5 times. Well, that busts our 2.5 times covenant that we have there. Again, like Ben said, the business hasn't changed at all. The business has not changed just because the accounting standard has. And so we need to look at that and we need to understand that, and we just need to figure out ways to address that. And those could be several things. One could be that leasehold liability gets eliminated from the calculation. Okay. One could be that the covenant gets reset. And part of that also falls on us that we all go, yeah, 2 times balance sheet leverage is fine. Well, in this situation, it's 3.5. And nothing changed. So it should still be fine, but we have to look at it in those terms because the company didn't change. As Ben mentioned, the cash flow didn't change, the income didn't change. but the way that it's perceived on the balance sheet did. And so you do need to talk to your banker about it and understand those different things and have those conversations early so that those changes can be made and we can account for that and allow for it and let the company continue to do what they've been doing.
Wonderful. Wonderful. But you did mention that there is a cash flow leverage metric that you also monitor.
Yeah.
Amanda, could you tell us a little bit about that?
Sure. So very similar to what Christine talked about, a lot of companies will operate potentially with both a balance sheet leverage covenant and a cash flow leverage covenant. Typically, a cash flow leverage covenant is calculated using funded debt to EBITDA. So as we've talked about, EBITDA in this situation with the new lease standard doesn't change. But your funded debt would, because in this situation, as those lease liabilities get brought on balance sheet, those would fall under the funded debt definition in most credit agreements. So very similar to what Christine talked about, you're going to have a conversation with your banker. So again, easy math, you start out with 10 million in funded debt and 5 million in EBITDA, and then bring on another 10 million in lease liabilities. Now all of a sudden you've gone from 2 times cash flow leverage to 4 times cash flow leverage. In normal times, 2 times is a very comfortable leverage ratio, usually for banks. Going from 2 times cash flow leverage to 4 times cash flow leverage, again, prior to the lease standard, would be a very big deal that you'd want to talk to your bank about. Now, we're all going to have to reset those norms with this new accounting standard. And so we're going to have to work through that. All the banks are going to have to work through that with their clients because leverage numbers are going to be much different than they have been historically. But again, that just warrants a conversation with your bank to see how you're going to address it. So again, as Christine said, you can have the lease liability removed from the covenant calculation or reset the leverage covenant to account for now having the lease liability on balance sheet. Another thing that you may want to think about, which is really from a regulatory standpoint, banks deal with a regulatory category that is tied to cash flow leverage. And we haven't heard from the regulators how this new lease standards is going to play into those limits. But for businesses that puts them above a 3 times senior or 4 times total cash flow leverage, that could have a meaningful impact into how the bank has to report that loan from a regulatory standpoint. And so that warrants a conversation as well. So the bottom line is make sure that you're talking with your bankers early so that you all have time to work through this together and make whatever appropriate accommodations need to be made so that there are no surprises.
Absolutely. So one thing that I am hearing, though, that's common throughout all the answers is, excuse me, is that it's important to have these conversations early with your bankers. So, Ben, when should your clients be coming to you? How should they be initiating these conversations? And do you have a feel for how long these types of discussions will take?
Yeah, sure. So ideally, the second you're thinking about it and contemplating it, as clients go out and they meet with their auditors and meet with their accountants and start discussing this and realizing it's something that they may need to adopt, that's a great time to get with your banker. And hopefully you've got a strong relationship where, every large decision within the company is discussed with your banker, because that's what a good relationship looks like. But in terms of turning something around, I think I could speak for all of us, due to the nature and the size of our banks and the way we operate, we're pretty quick to make decisions. And one thing that helps you make quick decisions is knowing your clients. So knowing their business and understanding this and having these conversations like we're having today allows us to turn something around pretty quick. And if it's a minor adjustment to the covenant, that can be done with a simple change of terms agreement. And that can be done as quick as a week. But those conversations do need to start before that so you can start modeling what is the impact going to actually look like.
Christine, I'm going to pitch this one to you. So what happens if the bank really hasn't started this process yet? Obviously, the three of you have given this some consideration. You're already working with your credit underwriters. What happens if your bank hasn't really started looking into this yet? Is there I would imagine some larger banks are going to have to use a one-size-fits-all approach because it's such a large lending base. But I love that some of the themes that have come through so far is that you're able to tailor solutions that are meaningful for your clients. Can you talk a little bit about that?
Yeah, so as Ben mentioned, with banks the size of the ones that we work for, we do have that relationship with our clients. We have a one-on-one relationship. We understand their business. They know who to call, and so they have a point of contact. Also, we have a smaller portfolio across which this is going to apply. If you are with a large financial institution, they may need to, just because the volume of this that's going to come through, this is going to affect most businesses out there, whether it's the small 18-month copier lease or it is a 10-year lease on their building, something is going to flow through their financial statements. And because of that, you're going to have large institutions that have hundreds and thousands of these to deal with. And they may need to take a more cookie cutter approach that says all covenants will change by this will be excluded, whatever that is. The good thing about working with a bank like the ones that we work for is we have the ability to sit down and talk to you and really understand. If this is that small copier lease that's a couple $1,000s, there's not a change that's needed. If this is a large real estate lease, there's a conversation we need to have, and we're going to understand the business, and we're going to work with you to find the best answer to that. And it allows us to customize that solution a lot more.
Great. Well, we're coming up on time, but I do want to open it up, Amanda. Just one last question. Are there any final thoughts, any recommendations that you would make that haven't already been addressed by the panel?
Sure. So as we've already talked about, just make sure you talk to your bankers, let them know that this is coming. And if you have any issues, if your bank's not being proactive in working with you on changing your covenants or addressing any modifications, then it might be time to look for a new banking relationship. So obviously that's why all of us are here. And we all, I think, would tell you and strongly believe that smaller banks with local management and local decision makers can be a lot more thoughtful and creative and nimble than some of the larger banks that are going to take a more consistent approach that applies across the board, but may not impact every customer in the same way. And we can be a little more thoughtful and individualize those relationships and how we respond to these changes.
Great. Well, I really appreciate you taking time with us this morning to go through some of these changes. There are pretty significant ones for the balance sheet, and I think you've done a really great job of kind of fleshing out what some of those pain points may potentially be. I would also encourage you, if you haven't done so already, follow Lane Gorman Trubit on social media. We do a number of these quick chats throughout the year. All of our education is available online, and we also do in-person events too. Thanks for joining us. We'll see you next time.